Hi, everyone. Welcome to 1x Insights. This is the market update for Monday, September 30th. The time now is 20 minutes after the market open. So there is a lot of information we have regarding how markets work. We have technical analysis, we have the Fed liquidity, we have the macro data, the non-farm payrolls, CPI, etc. And we also have equity seasonality, right? How equities on average perform in the past throughout the years. So I think we have to kind of organize them into a sort of a ranking in order of importance. In my view, I think technical analysis, so the price charts, should come first because while we may not have all the relevant information on a fundamental level regarding the macro state of the world or company fundamentals, the price chart always summarizes what the market is pricing in, given all the information that it knows for this moment. So the price information is always complete information with the volume, obviously, as a complement. And then we can look at the fundamental factors that affect the market liquidity, the macro factors, and individual stock or individual name factors. And then I think the seasonality is like the weather. It rains sometimes, it snows sometimes, it's sunny sometimes. And those will also have an influence, but it's more like a background trends. So I would organize those all the information in this hierarchy first, and then we go through all of the factors affecting the markets in this order. So firstly, I'm not doing a live charting today. So this chart is from 2 minutes ago. It's just to set a context for what we're going to talk about, which is liquidity and seasonality for October. So SPY, I think we're hitting a resistance level at 571 today. The 5 weeks up from the September low counts as complete. Obviously, can always further extend, but I think the move is still largely done, and I am expecting a pullback. The pullback may not be as deep as this; it could be much shallower. But I think there is due a pullback for the moment. But for the remaining of the year, especially after the November election, we should break new highs. Same with QQQ. I do think the pullback in QQ is potentially shallower with more legs to bounce. So, but yeah, again, 5 weeks up from September low, now hitting the resistance. This is not any different to what we chatted on Friday. TLT, I think in the near term, we can see a bounce. If we zoom into the 10-minute chart, the move down since FOMC does look complete. But I think we're likely gonna see a B wave bounce and before heading lower, which means yields heading higher. So what's been happening recently is curve steepening, which means the yields in the front end, like 1 year, 2 year, have come down, while the longer and 10-year to 30-year have gone up. So TLT actually has gone down since the dovish cuts from the FOMC. Then we'll be on to, this is something I didn't address on Friday, so it's a good time to address it now. So PCE data, so personal consumption expenditure, which is the inflation data that the Fed uses for its inflation target of 2%. So CPI comes in early in the month, but it only accounts for urban inflation, whereas PCE covers both urban and suburban areas. Unfortunately, it comes in the last Friday of the month, which is not as timely as CPI. And that has made the Fed unofficially placing a great amount of importance on the CPI data. But if we look at PCE, that is ultimately what judges what the Fed uses as a yardstick for its inflation goal. On Friday, core PCE was forecast to increase month to month by 0.2%. Actually, it missed that target. It came in 0.1% higher month on month. And the headline data for PCE also came in 0.1 lower than expected. So that takes us to a headline PCE of 2.2% year on year. The target is 2%, so we're very, very close. And if you look at the latest FOMC projection in September, they projected 2024 to end with headline PCE at 2.3%. So we are already below that. And again, core PCE nudged up slightly on a year-on-year basis, so to 2.7%, and that is just slightly above where the Fed is projecting for the year end. So ultimately, it's the overall level that really counts. I think the Fed, it has been more worried about the core inflation, but what they are going forward, they will say that the headline inflation, which takes the totality of data across goods and services and energy, etc., has come down pretty much within what the Fed expects, which gives them room to cut, essentially. So what's happening now in terms of Fed pricing? The market has become a bit less aggressive in pricing 50 basis points cuts for November, December, and January. So right now, the market sees 35 basis point pricing for each of the next 3 meetings. And that translates to 40% chance of a 50 basis point cut. So together, the market still expects a 50 basis point cut somewhere in November, December, or January. But it's not sure where, essentially. So the call for a 50 basis point cut in November has essentially weakened. And then now we're moving on to the Fed liquidity analysis. So something quite strange has been happening, which is that the Fed liquidity versus SPY, or the equities market, have diverged. As you can see, throughout 2023, the stock market and the Fed liquidity have moved up broadly in line with each other. I've added a 10-day average. So 10 days is basically a 2-week period. The 10-day average for both of those charts, so we can smooth out the daily effects. We saw that equities was pretty strong going into the year end last year and moving into spring, even as liquidity essentially collapsed from earlier in the year. And then we also had equities. So we had equities correcting in spring a little bit, and then moving quite strongly into the summer. And then we had the yen carry trade unwind over here. And since the yen carry trade unwind, both liquidity and stock market have both moved up. But overall, I wouldn't say the Fed liquidity is super strong. And in fact, in the past 2 weeks, it's declined a lot, quite significantly, from this 6.1 level to below 6 trillion. But in meanwhile, equities has stayed pretty big. And that could be due to, I think in the last webinar, from the webinar last week, I speculated there are several reasons for this. First, there could be a time lag between the reaction function of equities to the Fed liquidity. So if you think about Fed liquidity balance sheet expanding, usually affects the treasuries market first, which we'll see in a second, and then it moves its way into the risk assets. And secondly, we have China liquidity injection, which we will see in a second as well, with a Chinese stock market making a significant bounce in the past week. And And also third, there could be a resurrection of the yen carry trade. When I say yen carry trade, it doesn't just mean literally dollar yen. It also is indicative of the wider carry trade market where investors or traders are borrowing from low interest rate currencies and investing into risky assets in high yielding countries. And in terms of, so this header, you ignore this header. This is meant to say 10-year treasury yield. So in terms of Fed liquidity versus the 10-year treasury yield, it actually follows the thesis pretty well. So it holds an inverse relationship. So what that means is that when the Fed liquidity is higher, funding costs comes down. Yields, there's higher demand for treasuries and yields come down. And when liquidity drops, the yields move up. There's less demand for treasuries, and therefore it puts pressure on the price, treasury price, and therefore the yields come down. And therefore the yields come up. And what we see here is that as the Fed liquidity declines in the past 2 weeks, the 10-year bond yield also has moved up. So now let's look at the China liquidity. So China cut its 7-day reverse repo rate, reverse repo purchase rate last week, but they weren't done yet. So they on Sunday they have told banks to lower the mortgage rates for existing home loans before October 31st. So to be honest, they did mention this last week as well, but this is even more explicit now. And the impact is to reduce the existing mortgage rates by about 50 basis points on average. And it's because basically China has fallen into a real estate bubble bursting, a little bit like 2008 for the US. And home buyers have been under significant liquidity pressure. So helping home buyers reduce the cost on mortgages. The hope is that first it would resurrect the real estate market a little bit. Also with the easing on the real estate by purchasing restrictions in certain Chinese cities. But also it should boost consumption. So if people are spending less on mortgages, they hopefully can spend more on real goods. That could potentially have an inflationary effect. It really depends on to what extent people use their spare cash now on real goods, or it could inflate asset prices, as we'll see in a second, if people are spending that money into the stock market. So what we have is a chart on KWEB, which is the large internet ETF. We previously mentioned that the overall chart looks bullish, is consolidating in this space, is a 1-2, looking for wave 3. But I also said that we really need a confirmational signal breaking above this channel, because this could also easily be an alternative interpretation would be this is wave 4 still, and we're looking at wave 5 down, right? The higher the higher this goes, obviously, the less likely we're in this alternative scenario. So primary expectation we're moving up into wave 3, and we're currently in wave 3 of 3, with ultimate target of wave 3 above 60. It's done pretty well in the past month, essentially, moving just below around 26, now to 35, nearly 50% gain. Do I expect a pullback? Yes, I don't think this straight up move is sustainable. So the Chinese market will be closed for the next 7 days as a national holiday. So I think after national holiday, we could see some retrace of this move before moving higher. But I do expect significant moves ahead to the upside. as my main expectation. And I think the next leg down is a buy the dip opportunity, essentially. And also just to think about the alternative scenario of the carry trade resurrecting. So over here, I have the QQQ, which is obviously the risky equity assets in the grand scheme of things, versus the 10-year treasury spread between the US and Japan in blue, and US and China in red, right? So both spreads have moved down significantly in the past 6 months, primarily driven by a decline in the 10-year bond yield from the US. But as we can see that in September, it very much coincided with the timing of the equity market bottom in September. We see that the spread moving up, driven by the 10-year yield in the US, and also the declining yield in China as well. So we see both those yields moving up, both those spreads moving up, and equity markets moving up. So there is a chance that as the funding cost of the local currency, the low interest rate yielding currencies in China and Japan come down again, and then the return, as in the return in target currency, like the US, picking up again the 10-year bonds, we see money moving from those low interest rate yielding currencies across to high yielding treasuries or high yielding risk assets. So that could also explain the recent equities market move in the US. But as you can see, that this spread has topped recently as well in the past week or so, which I do think, together with the Fed liquidity shrinking, could provide near-term headwinds, right? So these are the secondary impact. And finally, moving on to SPY seasonality as we enter the new month tomorrow. I just want to bring up this historical performance for SPY. So what's noticeable about 2024, the year we're in, is that we printed essentially, unless we have a really big crash today by the market finish, but we have essentially got 3 consecutive positive quarters. And to be honest, in terms of the consistency of increase, is not that usual. I think the last time we had 10 plus, I mean nearly 10% Q1, and then pretty decent returns in Q2 and Q3 was in 1995, when the Fed did the rate cuts, mid-cycle rate cuts by 75 basis points in that year. And the market celebrated it, essentially. And then obviously over the years, as you can see, moving towards the dot-com bubble between 1995 and then 2000. So these are all the years where Q1, Q2, Q3 printed positive returns for SPY. And they look pretty good for Q4, right? All positive returns in Q4 except for 1 year, which is 2007. And that is the scenario we fear the most, because in 2007, the Fed started a 50 basis point cut also in September. So the odds are we are going to have a pretty good Q4 unless we fall into 2007 scenario. We've chatted about this before. I think the macro context is quite different between now and 2007. Suddenly, it doesn't feel like 2007, but with unemployment rates, it could move really rapidly, like it did in 2007 and 2001. So we do need to watch those macro factors just in case we are actually mimicking 2007. And if the investors notice that we are mimicking 2007, the chances are we're not going to have a steady decline like we did. Things will come much faster because we have more algos, and also there's a reflexivity in the market if you know something will happen, it will just happen. But overall, I think we're still looking very bullish H1 as well for the first half of the year for 2024. And the chances are, unless we're in 2007, we're going to have end the year pretty positive in the second half. And just to review September, to bring September to a close in terms of seasonality, I would say overall it tracked quite well, but it has outperformed compared to seasonality. So the thing we have to watch about seasonality is an average of all the years that happened, right? And every year is obviously different. So this is just an average. It doesn't mean that just because on this day, on average, is decline in September, it will always decline. Again, I think technicals come first, then macro and liquidity, which is our much faster signals. And then we can look at past seasonality to see, okay, so generally what investors want to do in certain month of the year. So I think it tracked this average quite well, and it's outperformed. We had a quite bad start to the beginning of the month, recovered in the middle, going towards CPI and then FMC, but a big rally the day after FMC to celebrate the 50 basis point cuts. And then it's kind of like consolidation the week after. So just to bring this to a close, typically October, first couple of days, probably a little bit tough, but should be okay towards the second half of this week. But the caveat is that October seasonality for election years tend to be not so good, which we'll see in a second. And also, one thing we have to bear in mind is that we just had the first cut. So it's also worth tracking what happens after the first cut, which I have brought into the Google Sheet. So looking into October, this is the seasonality for October of all years. So these are the daily moves. We can see that for SPY, a small move up in the first week. And then significant move down in the second week, move up again. So it looks like, if we're going to do with 1, 2, 3, 4, and then 5 finish on a high. So typically Octobers are not bad, but pretty good, to be honest. Same as QQQ, October is actually pretty good month, right? If you end up in a month, end the month 4 to 5% up, that is a good month out in my books. So again, on all years, QQQ is pretty good. IWM tend to be a bit of a zigzag consolidation throughout the month and finish strongly towards the end of the month. So now the caveat comes to election years. So in election years, equity is actually pretty bad. So before I go into how bad they are, I just want to say that election years essentially are picking out a quarter of all the data we have, right? If you think about since SPY is founded, there haven't been that many elections. So immediately we're reducing the sample size by 3/4. So I would always treat those charts with a pinch of salt. But just in case we are actually falling into, there's actually something quite special about the election years, which there may be. SPY in October in election years are not very good. It tends to decline pretty badly in the first month, and then it bounces a little bit. And actually, this would actually go with our CPI pattern that we've identified. In the middle of the month, equities tend to rally into CPI before and after, and then consolidate and sell off. So not very, so pretty bearish for election years for SPY in October, down 6% in the first 12 days. QQQ, the same, down 8% in the first 10 days or so. a little bit of a bounce, and then further sell off minus 10% in the month. And finally, RWM, pretty ugly as well, down nearly 12% by the 27th of the month, and then a little bit of a bounce towards the end of the month. And I think this has pretty big implications because I don't know if you still remember this chart from a while back. If we look at August to October equities returns, right, SPX, the 3 months before the election, the outcome of the election is actually correlates pretty well to the outcome of the equities returns in the 3 months before leading up to the election. Whenever equities returned negative, even by a little bit, the challenging party almost always won. And when equities returned positively, it's the incumbent party that won. So what happens in October? So we had an up month in August or September. So now what happens in October in the equities market is pretty pivotal to the election in November. I would even argue that by the end of the month, by the last trading day, we basically knew who's won the election as close as the polls have it. So it will be very interesting to watch how this month plays out, and then I think that corresponds pretty well to whether Trump or Harris will win. So I'm going to leave it here. Plenty of food for thoughts. Very interesting how October will turn out. So I think generally I do expect a pullback, but I do also expect the rest of the Q4 should be pretty positive. So later this week we're going to bring out more chart analysis for other topics like crypto and maybe some Chinese companies ahead of the Chinese market reopen. So stay tuned. Thank you.